exit the form. Hello, Stephen.
You have to unmute, Steve.
Yeah, if you want to speak, you need to unmute.
No, I'm sorry, yeah, I'm very clumsy here. Good morning to you, good morning to everyone. Sudipta, how you doing?
Excellent.
Ready to
Happy
go?
New Year.
Good.
Madeline is one of the brave ones with the camera on, so hi, Madeline.
Hello, good to hear your voice. I'm looking forward to the presentation.
It's Greg is presenting, so I'm just almost audience here. So.
So Sudipta, like from my previous virtual presentation experience, one of the co-authors would deal with the chat box comments because people constantly.
I'm happy to do that.
It's like two workshops going simultaneously. One is oral, the other one is written, and people just have all kinds of comments and discussions coming in. Yeah.
Yeah, so I was presenting at Seoul National last night, and so there was a chat box. My co-author was this thing, but the problem was that there were also private messages to me in the chat that my co-author couldn't see. So yeah. I wasn't. Yeah.
Are you ready, Young? I see the time.
Yeah. Mm-hmm.
All right, welcome everyone. It's great to have everyone here. Such a wide variety of people and a large number, which is fantastic. Thanks to Ayung and to Steve for setting this up. This looks to be a pretty interesting series of papers and discussions, and so I look forward to that, and I hope you do too, and hope others of you come back to for the next presentations. I guess we should also thank COVID-19 a little bit for pushing us to do this sort of thing, which is fantastic. And then also thank Greg for presenting and Sudipta for doing this work. Since it's the first one, and also to lay some ground rules here. So everyone except the presenter will stay on mute. And then if you have a question, you can type that into chat to say, I have a question. I will interrupt Greg at some point, at a good point, to be able to turn the time over to you to ask a question. If you would like to leave a comment or question without necessarily interrupting the presentation, you could also put that in the chat, and those comments can go to the authors as well. But if you do that, please just make a note that you don't want me to read that question or give you some time to make a comment. With that said, we'll give Greg 5 minutes to sort of get started before you make any comments, and then after that, if you have them, please type into the chat. All right, thank you for coming, thank you for participating, and Greg, we'll turn the time over to you.
Okay, thanks, Jeremiah. I appreciate the opportunity to do this. For my entire career, I've always thought that we should be able to do workshops like this, where everybody can show up in jeans and t-shirts and just sort of play it by ear. And so I'm happy to do that. This is a paper that Sudipta and I have been working on now for what seems like a long time, a few years, to put it charitably. It's a paper on the evolution of double entry bookkeeping, as the title implies. It's a theory piece, and I put that in quotes because it's not really a theory in the way that we normally think of it. It's an evolutionary story about double entry bookkeeping and how it was shaped over the centuries by an unplanned process where it emerged and developed in a vast range of local circumstances that were unique to the firms that were applying it. And so what you have is something that looks a little bit like a biological process where things can mutate and be selected in the environment and stuff like that. And that's how double entry bookkeeping came to be. It's recognized as such. Probably the most famous of the people who took this view, at least first, was A.C. Littleton. We considered three main issues in the paper, and these are questions that are typically applied to any kind of evolved trait or institution. First, what does it do? And what does it do differently and better than the alternatives? In this case, a single entry system, and I'll talk about what that means in a second. Then, by what mechanism did double entry improve over time? So there's got to be something that drives the process of evolution, and we'll talk about that. And then in the long run, why is it that double entry bookkeeping outcompeted single entry to the extent that double entry is used all throughout the world, and no firms, at least to my knowledge, use single entry bookkeeping systems at large scale. Then we're going to spend some time talking about how to get evidence on the theory, because like all conjectures, they are empirical questions, and this is no exception. And so we'll talk about how you gather evidence, and then I'll make some concluding remarks. Some caveats. First, what we don't say is that single entry bookkeeping has no value. It's persisted and is used probably in small organizations throughout the world today. Large ones don't use it, but it doesn't mean that it has no value. You know, even for a small firm, you have to have some sort of record of what transactions occurred. What we're arguing is that double entry is better than single entry on some very important dimensions in regard to profit discovery, that is, trying to predict the future of what's going to be the demand for products and services and things like that. The implications of double entry were not immediately recognized. You can think of it almost as an app where it's put out there and people start using it and they discover new ways of using it, better ways of using it. And those ways are tested in markets and subject to the forces of selection, where innovations in it that prove to be useful survive, and those that don't, they don't. We're not saying that profit as an economic construct did not exist before double entry. Probably 10,000 years ago, people would have had some notion of what profit is, that they wanted to receive things in excess of what they gave up in a transaction. And so there's nothing about this that says double entry bookkeeping was necessary for the emergence of profit as a concept. Okay, this is the accounting design seminar, and it's useful to sort of look at a process of something that is fundamental, and how knowledge about those fundamentals is necessary for the design. So something like a Bugatti sports car that can go over 300 miles per hour, is it possible that the designer of that car had no prior knowledge of how an internal combustion engine worked and why it is the choice in high-speed cars, at least for right now? The sense is that there's all these things that are out there in the world at a very fundamental basic level, and the internal combustion engine is one of those things. Do you really need detailed knowledge of that to design the car? Probably you do, right? So somebody can't walk in off the street. It's almost like a musician, trained musician. They have to have a lot of knowledge before they can do the things that they are able to do. So if we look at the annual report in 2019 of Bugatti's parent, which is Volkswagen, a couple questions come to mind. If you do a word count for double entry in Volkswagen's 354-page annual report, the double entry term, hyphenated or non-hyphenated, doesn't show up at all. And it's that way, I think, in most, if not all, large corporations, that when you go to the accounting policies footnote, you will see no mention of double entry. It's sort of assumed that it's going to be used. And the second thing is, do we actually miss anything in setting accounting policies for double entry based reports if we don't fully understand double entry's foundations? I think the answer to the first question is obvious, and we don't frame it that way. The second is a much trickier one. So there are people all over the world and people sitting in this seminar today who know a lot about accounting. And they can set policies for firms, and sometimes they can set standards that are applied in economies or across economies and things like that. And so they don't per se need detailed knowledge of the evolution of double entry bookkeeping to do that, to do it beneficially. But I think at some level, our hope is that in the long run that this will be beneficial, that we will know a little bit more about this than we know today. And it may help in sort of thinking about what the unintended consequences of action can be. And I'll talk about that a little bit at the end as well. So let's get into the meat of it. The story that we're telling here is that accounting measurement is co-determined along with the structure, scale, and scope of economic transactions and the mental evaluation of those transactions by the people that are engaged in them. The directional effects are going both ways, and the key elements is that they're endogenous and they grow through time. They strengthen as interactions become repeated and in large numbers. Accounting measurement affects transactions both directly and in terms of how it affects how people see the transactions. And so in that sense, it's all balled up in there together. It's a tight linkage. And the measurement system quality, and I use that term loosely, influences the strength of the links between those factors. And it's not something that's a simple, straightforward kind of thing. It's something that's, and it doesn't happen instantaneously, and people don't even necessarily recognize that they're doing it. But it's there, and that's what the paper is about. Transaction analysis and profit measurement with single entry. What happens is that most of us who are trained in double entry, we think about the world in those terms, and it's very difficult for us to see how the world would have differed in the period before double entry bookkeeping emerged. Single entry accounts, they provide running counts of items owned, not necessarily in dollar units, and so they're just physical units. A rancher could track the number of cattle owned and the units of currency like pennies or silver dollars that are inventoried separately. But the goal is to reduce theft, and so the idea is to track what you own and how it changes, mainly to make sure that people aren't stealing your stuff. Transaction analysis under single entry focuses on immediately observed resource changes for the transaction with profit recognition delayed until the books are closed. So the way that it would work, it would be almost like a fair value system. You would inventory the assets and liabilities at the end of the period, look at the changes over the period of time, and then you could identify the total profit for the period that way. An unrealistic single entry example. It's unrealistic because it's for illustrative purposes. It's not a depiction of actual reality of any given firm. Candy store buys a pack of chewing gum for 37 cents, wholesale paying 1/4, 1 dime, and 2 pennies. When they enter that transaction in a single entry system, they know that inventory goes up by 1 unit. The quarters and dimes and pennies go down by relative amounts. On the second transaction, you have the inventory going down by 1 unit, quarters going up, dimes and pennies going up as well. So at the end of the year, the profit is calculated over all transaction by balancing on the balance sheet equation, and you look at changes over time with respect to equities. Transaction analysis with double entry bookkeeping is a bit more subtle. So the debits equals credits rule imposes constraint on all transaction that encourages, doesn't require, encourages the use of wealth accounts to balance journal entries for profit-seeking transactions. And what that does is that it changes the focus of attention of an entrepreneur to the change in the wealth. and to start to think more deeply, not that it wasn't thought about before, but think more deeply about how wealth is affected by different kinds of transactions. And so the idea that you have to balance the debits equals to credits means that you have to be able to explain what is happening when you have a difference between items going in and items going out that are constrained by the amounts of the entries on the debit side and the credit side. What that does is it leads to more of a focus on future contingencies that make double entry bookkeeping transaction analysis much more complex. And so when you think about that and the way that it changes, how the questions change as you go through time and transactions become more complex, you're asking a very different set of questions to balance the entry under double entry than you would under single entry, because under single entry, you don't have to do any balancing with the debits and credits. You're just doing a physical count of things that are changing.
Greg, there's a question.
Okay.
Ayun?
Hi, Greg. So it sounds like this double entry design kind of like help entrepreneurs kind of like realize the decisions in sales and then investment, all kind of business transactions, whether will lead to a positive NPV projects. So like they need to keep that in mind. That's what each of their decisions actually are generating profits. But my question here is that it sounds that that will be the process within the firm, potentially relates to their internal managerial accounting systems. And potentially they have that in place, but potentially that system is not consistent with what we observe as an outsider from the financial report.
Correct.
So can you help me kind of reconcile these two in terms, because
Yes.
usually we don't really see what firms use within their institution. Yeah.
Well, when this stuff came about, there really were not the large scale organizations that had thousands of equity owners in the firm. Double entry is essentially a managerial innovation. It allowed you to manage organizations better. And then subsequently down the road, it got put to uses when firms expanded and capital was provided by a large number of external owners. So it's a function of financing arrangements in place at the time that the method emerged and was applied in practice. So it's essentially the way that we see it here. It's essentially a mechanism to allow managers to make more profit-seeking decisions successfully than they would with a single entry system.
I see. Are you aware of there's any field studies that have kind of like observed how a startup business as it grows, they're actually migrating from the single entry to double entry?
Well, no, that's what we'll talk about at the end with the empirical stuff. But that would be like the first place to look. So what is it that happens when a startup organization makes the decision to move from a single entry system to a double entry system? I've seen studies, the ones that I'm most familiar with have been published in Accounting Review, but those are, in most cases, companies that have existed for 5 to 10 years. The closest thing that I've seen, but I haven't tracked subsequent innovations, is the paper by Gavin Kassar, which I think was published in 2009 in the Accounting Review. But that didn't deal with double entry per se.
Thank you.
You're welcome. So if we think about applying double entry to the unrealistic example I showed you before, we've got a situation where the entry of the transactions is forced to equate debits and credits. So when they buy the inventory paying cash, they're debiting inventory, crediting cash. And when they make the sale for an amount that exceeds what the inventory cost, they make the entries to balance as a credit to the inventory, a debit to the cash, and then the difference between the two goes to an equity account that I've labeled cumulative wealth here. So the mental evaluation of transactions under double entry goes something as follows. You have a consumer and a producer who proposed and consummated a transaction. And then after that transaction, the consumer discovers the utility derived actually from buying the commodity. And the producer discovers the profit that he or she earned as a result of that transaction. There may be some post-exchange obligations, such as warranties or various and sundry other things, like financing. On the demand side, there's a feedback loop. The question that the consumer is going to ask is it worth what I paid for it? And then after the fact, they're going to ask the $64,000 question is, would I buy this same product again? And that's going to feed back to the consumer, and it will affect their decision to interact with this firm or other firms similarly situated in the future. On the production side, they're going to ask a question during transaction analysis of recording. Did I earn more than cost? Right? So was this transaction beneficial to me in the sense of that I earned more than it cost me to produce the product? And after that, they're going to ask, should I change what it is that I offer? Or should I change the price? Should I offer it in a different forum? All kinds of things. And that has a feedback loop on the supply side that is going to be occurring as well. So the story that we're telling in this paper is that the feedback loops on the supply side of a market are stronger with double entry than they are with single entry, because the questions posed in transaction analysis are different under those two systems. So under double entry, they're trying to figure out, was this a profitable transaction for me? And should I change what I offer? The focus on tracking what you own and making sure that it's secure, it's going to ask what resources have changed and have my interests been protected. But there's not going to be the emphasis on profit that there would be with a double entry system, in the sense that it calls it up more readily from the way that the system works in recording the transaction, subject to the debits equals credits rule. So what stronger feedback from double entry fosters is more rapid adaptation to change profit opportunities. And it works like a set of eyeglasses that improve the vision of what otherwise would be murky and difficult to see. So under single entry, if you have a unit costing $40 and you get cash, and when selling, you record the reduction in inventory of in terms of units. Cash goes up by 50. And if you can have a set of transactions that, if you look at on the left-hand side of the graph, you could have a set of profitable transactions, a set of loss transactions, and the entrepreneur may have some sense that it's profitable or not profitable when any given transaction occurs, but it's not going to be as precise and crisp. The result will be at the end of the period that they can identify the total profit by application of the balance sheet equation, but predicting future profits, because they can vary by product type, is going to be much murkier. So these bubbles here are shown in weaker font. Now, if what we're saying is that with a double entry system, the system allows you to do better in terms of identifying the profits on individual transactions. And again, it's not to say that you can't do that with single entry. It's just that double entry encourages you to do that much more accurately than would be the case otherwise. The result is that it's going to be easier to segregate the profits by product type at the end of the period. And the result of that is going to be that you can figure out more accurately what the future profits are going to be from one versus the other, and then adjust accordingly. So it's in that sense, when we talk about profit discovery, what we're talking about is the prediction of future profits. And those predictions or forecasts are going to be more accurate under a double entry system than a single entry system, everything else held equal. Go through three examples. Somebody has contracted to build a bridge across a river, and that transaction settles for a price to the buyer of $60 million. That they're going to build a bridge that takes 3 years to finish. The buyer pays 10% down with the rest paid in equal installments at the end of the next 3 years, right? So the cash that changes hands right now is 6 million. The anticipated cost to complete the project is 50 million, and it implies an expected profit of 10 million. So the initial entry under single entry is to recognize the cash increase of 6 million and nothing else. You can sort of pack up and go home, and that's what you've done your job for the day. But with double entry, you debit the cash for the 6 million, but what gets the credit? Something has to get the credit. Is it a revenue or a liability or something else altogether? So the question that arises with something like this, how is it that accounting data from similar transactions that have occurred in the past can be useful in determining future accounting choices because you can predict outcomes much better than you might otherwise? Anyone who's ever been to Steubenville, Ohio, can see this bridge across the Ohio River that is the successor to the bridge that Carnegie built in 1865 at the end of the Civil War for the Pennsylvania Railroad as they expanded their network across the country. When Carnegie started in business, he was surprised to learn that other firms that he would be competing against computed their profit numbers annually. And they took on projects where they were unsure about whether the project would be profitable. Again, they would make a bid on something like a project like this, and the noise or the imprecision of their estimates around the future profits of it would be more noisy. So what that would mean, presumably, is that the bids that they would submit would tend to be higher, and Carnegie could conceivably have a profit advantage in predicting the cost better than their competitors. He's a big believer in double entry. He learned it in a night course that he took as a teenager, and Carnegie Steel actually had it written into their corporate charter that they was required to use double entry bookkeeping in keeping their books. And one of his big innovations was to develop a double entry based cost accounting system that allowed his firm to ex ante estimate the expected profits from a specific project better than his competitors would. That's the story. Second example is out of chapter 20 of Pacioli's Summa Mathematica. And it talks about the accounting in Venetian overseas trading ventures. And this is important because it tells you what they're after was finding out what the profit was on specific products. And the second paragraph there is describing what happens when you transfer the stuff that you've recorded in a memo book to the ledger. And it says, without entering the value of things you've traded, you cannot from your books and accounts learn except with great difficulty what your profit and loss is. The next paragraph, you may keep a separate account of goods received in trade if you wish to do that in order to know how much you make out of them separate from those of the same kind that you already have at home, or separate from those that you might get after that in order to know which was the best transaction. That is the idea that the system is set up in such a way that because there's the bifurcation of different types of transactions easily accommodated, you can identify the profits on particular products and particular ventures. The third example is 19th century US meat packers. This is a book written in the 1920s on cost and accounting methods in the packing industry. And it talks a lot about how you set up the accounts in ways that allow you to access the information and use it on a day-to-day basis in figuring out what you want to do. So a big issue if you're a meat packer is when you actually make the decision to start the process of basically slaughtering an animal and extracting its meat. Tracking, classifying, and analyzing costs generated in meat packing would have been exceptionally difficult in a single entry system. Again, it's not impossible to do that. It's just very difficult to do that. So the way that the entries would have worked for a meat packer in those days. So somebody like Oscar Mayer, whose company produced these cute little jingles, and we can still sort of sing them to ourselves. He actually started as a corner butcher in the near north area of Chicago. And I can imagine a matter of blocks away from Michigan Avenue. So he started as a corner butcher, the same with Swift and Eckrich. Each vertically integrated into wholesale meat production involving animal acquisition and processing with wholesale marketing, sales, and distribution networks that expanded gradually over time as these firms grew, mainly due to improvements in railroad transportation for the processed meats. So the way that it would work is that when you buy cattle, you purchase it at cost, the debit going to essentially a raw materials, if you will, type of account called cattle on the hoof, and the credits going to cash or payables. When the animal is transferred into the process of meat production, there's a credit that goes to the raw materials, debit going to basically work in process. Additional costs get added onto that. And then the accounting for it when the processing was complete is that the byproducts would be transferred into a debit in byproducts inventory at their wholesale prices that were observed in the market that particular day. The plug in the entry would be the processing, the debit that goes to dressed meats. And then there would be a set of credit entries when those items were sold in the market subsequent to that.
Steve Penman has a question.
Hi, Steve.
Hi, Greg. How are you doing? Yes, I have a question. Very interesting. It all goes through the transaction analysis about profit discovery through the double entry system. I'm thinking of fair value accounting.
Yeah.
That in a double entry system. Would I be correct to say that fair value accounting actually ignores a double entry system in the sense that if I got the fair value in the balance sheet, I'm totaling up my coins or whatever, single, yeah. I've got the value and I've got the profit, okay, right. Because it's a change in the balance sheet. That is a system that does not exploit the double entry system. Yours is all about a system where actually it's not fair value accounting, but this is transaction analysis from which we're trying to extract profit.
Correct. That's exactly right. Which is not the same as saying that, you know, fair value ignores double entry, because most firms where they're applying fair values would be using a double entry system. But it's also the case that, you know, it's not necessary. You could easily implement a fair value system where you fair value the assets and liabilities at the end of the year and you calculate the profits that way.
Okay, fair enough. Thanks.
Okay, empirical research, which is, I think, critical to this. If you want to look at data, how do you do it? And it's not straightforward, because when we typically tend to think of this empirical research, we have data that we're going to get, and then we're going to tweak an X variable and look for changes in Y variables. And that is a bit difficult to do here, mainly because what you want to look at is how does it change when you change the accounting system itself, and that's so rooted in any archival data that you're going to see that it's going to be difficult. And so it requires that it be a little bit innovative and entrepreneurial in collecting data to look at this. So what's the hypothesis? The hypothesis is that double entry is essentially a force multiplier in economies where profit discovery is essential. And you can think about this as there would be profit discovery occurring in a single entry bookkeeping firm, but it would be more rudimentary than it would be under double entry. And so in that sense, double entry is profit discovery on steroids. That's the story that we're telling here. And so if you think about a regression setup, you might have a profit or performance variable on the left-hand side, and then a 0-1 indicator on the right-hand side for seeing double entry versus single entry systems. We don't think that's going to be a particularly profitable way to explore this. And what we're really talking about is a circumstance where assets are mapping into profit and performance, and it's the structural coefficients in that model that are changed by the nature of double entry. And so accounting systems don't come about because people want to do accounting per se. Accounting systems come about to help people make better decisions. And we've known that for a long period of time. And so what's underlying this is the notion that the measures that we take of the system map into performance and profit differently under a double entry system than they do under a single entry system. And that requires a different, more subtle approach to the empirical work than you might otherwise consider. So we've got suggestions under what, how, and why. And what, I have not seen any empirical work that looks at firms' initial adoption of double entry bookkeeping. I don't think organizations, most are born with double entry in mind. Probably early in their existence, they have accountants or bookkeepers that move the system more to double entry. How does that happen? When do firms make that decision? How do they internally organize their bookkeeping functions? Do they outsource them? When does that occur? Is the CPA hired as part of that process? And most importantly, does the internal tracking of profit components change as a firm scales in size and is using different kinds of systems? So some years back, Sudipta and I were speaking with somebody in China who had access to data of firms, and they were curious about how it worked to change the accounting system as they moved up. Ideally, something like that would be a great source of archival data, but mostly we're envisioning that it's going to be surveys and talking to people who've actually gone through these decisions and documenting what it is that they do, how successful it is, what things tend to be more successful than others. How does learning double entry bookkeeping change how an accountant analyzes a business transaction? So we have in mind process tracing techniques of the kind that Herb Simon and others used in the 60s and 70s to study business decisions. How does experience using double entry bookkeeping affect the ability to forecast future sales and earnings? So there you're going to have to look at the experience of actual firms. And there's a part of it that looks at brain structure and how, if you will, this may sound a little bit way out there, but how brains get wired when people learn double entry, and is it different than how they learn single entry? And this is a possibility of tying the physiology of the brain within an accountant to the notion of transaction analysis and how that works. There's an area of neuroscience that deals with plasticity of the human brain, which is essentially that the brain is adapted to the experience of the individual. And so we expect that we're going to see, if you actually look at accountants' brains, that they're wired differently, that the connections between areas of the brain that look at valuation and uncertainty are going to be wired differently there than they would under somebody with only a single entry perspective.
Greg, I got a question.
Sure.
And sorry, this it takes me most of the time to process what you started with. It seems like you started at you're presenting sort of maybe a starting point and an ending point. Do you have any concept of how it gets from the starting point to the ending point? Right. So for example, it seems like double entry accounting, one of the things it's doing is labeling, right? So you're saying, here's where cash came in, and this is what I paid, or I bought something with this cash, or I collected this, right? So you're labeling each transaction, and that doesn't have to be done in a double entry system. You could just label.
Correct.
And then you move to the next part, which is I think you spent a lot of the time talking about, is how do we put revenues and expenses or profits to this number.
Mhm.
Do you, I mean, to me, I would be curious about how you get from beginning to end, because if you can imagine if we went back in time, and I think there have been some proposals like this, over the past few decades, that if we could just label every transaction, and now with our big computing power, you can go in and do everything you want with all of that data.
Yes.
So I would just be curious, what
Well,
is it necessary to end at this point and begin at that point, or can
No,
we
it
think
isn't.
about in between?
So what we have in mind is a continual process, right? And the way you can think about it is that at any one point in time, so if you go to, say, the year 1200, and you look at every profit-seeking organization in the world at that time, nobody is using double entry because nobody has figured out how to do it yet, right? 1211 seems to be the earliest time that Italian organizations in the city of Florence started to use it, financial institutions. And then it spread such that, say, at 1250, there were more firms using it, and then at 1300, there were maybe even more firms. And each of those firms is applying the method in practice and that their accounting system, in some sense, drives part of their business decisions. And those business decisions affect whether that company, whether that firm is going to survive or not, right? And the environment produces a selection effect as to whether their application of the information system in the environment within which they're making decisions turns out to be wise. And so at each point in time, that's occurring, right? And the way that the knowledge makes its way into the firms that are going to put it into practice is through things like education or experience of working at other firms and things like that. But the key mechanic is happening at the level of firms, and those firms structure information systems to compete better in their environment. And so at any point in time, like today, everybody across the world who's at all any size is using double entry, right? It's completely driven single entry out of the market for accounting systems, at least in large corporations, large firms. And the quality of the accounting system in terms of how it processes feedback from the environment determines the firm's success, its survival. And it's that drives innovation in the system as a whole, because experience at the individual firm level feeds back to a societal level as people learn what other people are doing and things like that. That's a large chunk of what the FASB does, right? So what they're looking at is ways to evaluate transactions that experience suggests tends to work better than it would otherwise. And so it's not something where it's unique or independent of the actions of human beings. This stuff is getting applied in firms, and it affects whether they survive or whether they don't survive, even though we don't necessarily see it that way. So that's a long-winded way of answering your question, but I think that's what we have in mind.
Okay, that's great. I just wonder then if we could have evolved to a different state, or if we will.
We could have, yes.
So I think there might be another comment or question. I see Douglas Hanna has his hand raised. I could have missed this a long time ago, so I'm not.
No, that's fine.
Hi, Doug. How you doing?
I'm doing well, thanks. In your very first example on chewing gum, the single entry bookkeeping system, it was sold at 49 cents.
Yeah.
I'd be interested in hearing you discuss more about how the decision to sell it at that price was reached. Because it's not like in a single entry bookkeeping system, the proprietor is unlikely to be thinking carefully about what those sales prices should be.
Correct.
So is there some sort of substitution between thinking about profit that happens within the accounting system and thinking about profit that happens externally outside of the accounting system?
Well, that's a great question. So, my sense is and this is a conjecture, I don't know this for a fact, but if I think of, say, a retailer, a general store that operated in a small town in Wisconsin in the 19th century. So what is it that they would decide to try to sell? They would basically stock the store with things that they thought people had bought in the past at prices where they could sell them for more than they cost to buy them, right? And the signals that they would use on a day-to-day basis is that it would probably involve something as simple as the extent of dust on the shelves, right? Things that weren't selling at the advertised price would have to be marked down and things like that. So that the accounting per se is not the driver here, right? The accounting is a tool for leveraging the decisions that are getting made with regard to product portfolio, pricing, probably interacting with suppliers and how you get things at a reasonable cost and all of that sort of thing. And the signals that the entrepreneur is using is not necessarily restricted to the accounting system. It's simply the accounting system is a tool as part of a broader mosaic that drives the decisions. And so in that sense, the accounting, I mean, we like to think of accounting as like being very important, and it is. But normal people don't exist to do accounting, right? So when we think about accounting, we think about it being a derived demand from a need to record and analyze transactions. It's not something we would do if we didn't have the transactions. And so, you know, I guess my answer to your question is maybe not a very satisfying one, but the answer to the question would be akin to the accounting system provides a useful input into pricing and placement and marketing decisions, but it doesn't drive them in its entirety.
Well, I certainly take that so many firms use this system that it must be useful in some very important way. You, in your discussion, were trying to link it to this profit identification maybe being easier. Yeah. I think you should also layer into that conversation the fact that in a large corporation with the separation of incompatible functions, we often have the revenues and expenses being recorded in different parts of the corporation. Correct. And we don't, the double entry bookkeeping system specifically avoids the calculation of profit until we go later on to close the books and compare everything. So, well, when you prepare an income statement, you put your revenues and your expenses together. Until then, you have accounts of revenues and expenses and not a specific account for profit. So your emphasis on profit on a transactional basis, I'd like to see that strengthened a little bit in the double entry sense. I'm curious to hear your view.
Well, the sense is that if you have a demand for that information because you have to make a business decision and you haven't reached the year end, it's easier to get the information out of a double entry system than it is a single entry system. That's really the story. So it's not that you're physically doing that on a regular basis. It's just that, say, if you need to prepare a specialized report on whether certain things are more profitable than others that you've been stocking, it's much easier to get the information to do that in a double entry system than it is in a single entry system. It's not that it's impossible in a single entry system. It's just that the circumstances in which this method emerged, it would have been harder to do single entry than double entry. So in other words, you can think about it as being more flexible, more adaptive in that sense relative to the benchmark of a single entry system. It takes the data and it parses it into different components where it becomes easier to identify it sort of on the fly.
Okay, thank you.
To extend that, it's sort of, we're thinking of this as starting out in a retail industry, but then once it went into manufacturing, we do have this cost allocation system that's layering the costs into inventory. It's just that it doesn't go as far as layering the marketing and other costs into the inventory. And so when you sell the product, you're getting a gross profit, not the net profit on a product by product basis. So it's getting you partway there, but not all the way there. And that may be because those decisions are made sort of differently than the decisions on the production level, because the production level is on a unit level, R&D and marketing are on a brand level or something like that. And so the locus of decision and the nature of decision making may be different. So in principle, we could have pushed double entry all the way to putting all those costs into the inventory so that when you sell a product, that, that revenue minus expense thing is revenue minus cost of goods sold is your net profit. The fact that we haven't done it says that there's something about the decisions on those other expenses that's different from the manufacturing expenses. If you just think about cost accounting and how we do cost accounting, what costs are at the unit level and what costs at the brand level, there's probably a good reason why there's a separation. So it's not, I mean, obviously people have tried it and then they haven't done as well as the people who've got the system we have. That's sort of the evolutionary story.
There's a follow-up question as well, Aruj.
Thank you, Greg and Sudipta. Very interesting. I mean, I've been teaching double entry for a long time. I haven't thought so deeply about it. So this is very interesting. I do see, I think, like a big, one subtle difference is what you just pointed out is the ease of pulling some relevant information for decisions. That's different between the single entry and the double entry book system. But do you see double entry being the gold standard, or is there a system out there that can improve upon what we have right now?
Well, I think, the person who really thought more deeply about this than anyone who'd ever lived would have been Yuji Ijiri. And he's not with us anymore, and I'm hesitant to put words in his mouth, but I mean, he did write a AAA monograph on triple entry bookkeeping, right? Which was a system that would allow you to identify the changes in profits over time. And so he would have said that, yes, there are things and ways to do it better. And in the future, there's a possibility that will actually emerge. And so there could be in the future things that displace double entry. But I'm not smart enough to figure out what those are. But it could be that, if we came back 100 years from now, that people would be using a triple entry system, and they would be using that all around the world to identify the profitability and changes in profitability of a business through time.
And another question.
Sure.
Stephen.
Yeah, I have a follow-up on two things. A follow-up on Doug's point and a question. On Doug's point, I think the closing entry is a combination of double entry system and a balance sheet equation. You can have a balance sheet which doesn't balance. It's just assets minus liabilities.
Right.
Recorded on the double entry system. The closing entry is forced by the fact that you now want a balance sheet where actually the debits and credits of the income statement and balance sheet reconcile in satisfying the balance sheet equation. So I think there's an extra accounting element here, the balance sheet equation, which actually forces the closing entry. The second question I want to raise to you, is there anything in the double entry system which is restricting? And I'm thinking that is, there's certain things you can't record. And I'm thinking particularly of those who propose that certain intangible assets should be on the balance sheet, okay?
Right.
And I'm thinking of those intangible assets which are not a part of generated by a transaction.
Yes.
For example, social capital should go on the balance sheet. We're in a company with good legal systems and laws and political systems. We're starting to doubt that a little. Should we put that on the balance sheet? Should we put organizational capital on the balance sheet? Proposals for this. And of course we can do it, we can measure it, but then there's a question of under double entry system, you've got to have a credit entry.
Right.
And then what the hell is that credit entry? If I don't have any, it's not, is it profit? If I don't have any articulation or understanding what that credit entry means, then the double entry system is sort of ruling out that I recognize assets. Is that, I'm just thinking here aloud. Does that go along with your thinking?
Well, in terms of my thinking about it, my sense is that double entry is the system that leads to a set of questions about how you analyze transactions, right? Now, there are circumstances where you can think about the firm having a transaction with nature, where there's been some realization because the firm is situated in a particular place or time, and that is reflected in how they do things. And so my take on it is that if you start to admit the possibility that the transaction set can extend beyond what we typically tend to recognize in accounting, then it's very possible to include that in a double entry system. And so in that sense, you know, the double entry system drove how it is that people viewed transactions. But, you know, at some level, if you wanted to get really metaphysical about it, that, you know, it could be applied to transactions with nature. But the problem is that there's not really any definite limit to that. And so the application of the double entry system, it implies certain things about what constitutes a member of the transaction set. That there has to be, in most cases, a living human being on the other side of the transaction. But there still are cases where there are transactions with nature that get recognized. So for instance, when you have an asset impairment and a value that's attached to it on the balance sheet is no longer applicable because of some negative event. And so, you know, it gets expanded in some cases, but it's severely constrained by other things that subsequently followed, like conservatism and things like that.
Great. We'll have the last question. So Rajiv has a question, and then you'll have just a few minutes to wrap up.
Okay.
Greg, great work as always. Enjoyed reading it. One of the things that perhaps you could talk about a little bit more is the object of accounting. So we have entity theory, and so far we've been talking about proprietors. Stephen's question was very interesting because he talks about value that's generated from, let's say, past conduct, but it hasn't been realized and there's no tangible way to measure these things.
Yes.
It seems to violate the sense of it being the property of the shareholders, the owners. Right now, it's something to be realized by future conduct, such as honoring the contracts and commitments they've made, a Rio Tinto being an example.
Yes.
And so I'm wondering whether the focus on the stakeholder for whom we're doing the accounting might change, and that might lead to different classes of fundamental elements that expand the set of liabilities and equities on the right-hand side of the balance sheet. Could there be a role for recording things that are not liabilities and that are not equities? This question has been pondered in the past, and I'm wondering if you have any thoughts on that. Thank you.
Well, it's not really addressed directly in this paper. So for purposes of this presentation, I don't really have any thoughts about that. I do think that the term stakeholder can add ambiguity and confusion where less of it existed before. So I'm not a fan of that term. So like I guess this is the business conference who wanted to change the emphasis from shareholders to stakeholders in firms. I don't know exactly what that would lead to. And I don't know exactly what it would lead to in the context of this paper. So I think I'll just sort of stay away from that. Jeremiah?
Yep, you can, you got a couple minutes to wrap up.
Okay, perfect. So what does the paper do? It adds to actually a fair body of work on double entry and capitalism. Werner Sombart, Max Weber, Ludwig Mises, and Joseph Schumpeter had argued nearly a century ago that double entry bookkeeping plays a major role in the emergence of capitalism. But it's not 100% clear why that occurs. But the thing with Sombart's story, Sombart's hypothesis, is this notion about profit dominating the whole system, that it sort of elevates it to a level that it wouldn't have existed with in the absence of double entry bookkeeping, that it becomes an even greater factor in running organizations. From the standpoint of accounting research, A.C. Littleton, Ken Most, and Yuji Ojiri all emphasize the centrality of double entry bookkeeping's role in income measurements for organizations via debit credits. On the economic side, Adam Smith in The Wealth of Nations said, "It is only for the sake of profit that any man employs a capital." And he's in this, as in many other cases, led by an invisible hand to promote an end which was no part of his attention. So our story sort of melds all of that stuff together. But what we're doing here is not in any sense greatly original. And our story is focused on double entry, improving future profit discovery over single entry by promoting timelier and more comprehensive profit measurement in real time than would be the case otherwise. The takeaway on the accounting design project is, go back to Friedrich Hayek, that this paper doesn't really indicate doing one specific thing or another. It does advocate humility, that when we think about designing accounting practices, and say, for instance, at a firm-specific level, how you do one thing versus the other, humility is required, because oftentimes we don't really know exactly and comprehensively what it is that we're turning loose by making one decision versus the other. And Hayek advocates an incrementalist approach, I guess, to social engineering. And I think we would be well suited to remember that in the future. So I'm plugged for the next one, September 24th. Same time, same bat channel. 11 to 12 Eastern time. Paul Zarowin from NYU will be talking about the information benefits of R&D capitalization. And so I will leave it with that. Thanks for the time and your comments. They were helpful. I'm glad that you could attend and join us today. My thanks to each and every one of you who are here.
Thank you, Greg.
Thank you.
And
Thank you, Greg.
Thank you.
Thank you. Are we done, Jeremiah?
We are done.
Yeah, we're done.
Thank
Good
you.
job.
Okay, thanks. Hi, Sudipta.
Done. Thank you, Ayam.
Okay.
Yeah, thank you both.
Okay, you take care, and I will.
Yeah.
All right. Bye-bye.
Bye, Panos.
Bye-bye.